Hi there, and thanks for joining us here at PhillipCapital Market Watch. I'm Yeo Sze Han, Senior Dealer from Contracts for Differences, CFD. US President Donald Trump's comment at a news conference last week suggests that he sees no hurry in closing phase 1 of the trade deal with China and that there may be merits in holding off on striking any trade accord with China until after the US presidential election in November next year. His comments sparked a panic in the market and stocks around the world traded lower in the days that followed. Although markets have since rebounded and the three main US indices are now trading back near their all-time highs, a lingering fear persists over the possibility of further sell-downs as we approach 15 December, the date that the US has scheduled to put into effect a new 15% tariff on an additional $156 billion worth of Chinese goods. In the previous two rounds of tariffs in May and August, markets have reacted by falling back around 4 to 7%. China's main demand for phase 1 of the trade deal is for the US to remove or to reduce the tariffs that have been imposed since the start of the trade war, but Trump has seemed reluctant to accede to this request so far. The US, on the other hand, wants China to commit to annual purchases of $40 to $50 billion worth of US agricultural products, a level that is significantly higher than the $8.6 billion that China bought from the US last year. China has said that they will increase their purchase of agricultural products, but the purchase amount will have to be adjusted according to market conditions. Recent events suggest that the president may be in the mood to play hardball with China on trade in the coming week. Just last Monday, Trump hit Brazil and Argentina with steel and aluminum tariffs after accusing them of snatching market share from US farmers through massive devaluations of their currencies. On the same day, Trump proposed hefty levies on wine, cheese and luxury goods imports from France after the latter introduced a new digital tax targeting big American tech firms like Facebook and Google. Commerce Secretary Wilbur Ross echoed Trump's view in a separate interview with CNBC that waiting until after the 2020 election to reach a trade deal with China could take away some of Beijing's leverage. He also said that the US will go ahead with its plan to add tariffs on Chinese goods if nothing changes come mid-December. Another factor adding to risk concern this month is that the market seems to have moved too rapidly from early October to late November, with some going as far as terming the run a market melt-up and warning that the US indices may be due for a pullback soon. The S&P 500, for example, had surged 12% in the span of 8 short weeks. In view of the increased risk to the downside this week for equity markets, traders in risk-off mode are taking capital off of their equity bets and are switching into products such as gold, high-grade bonds, and safe haven currencies such as Japanese yen, Swiss franc, Sing dollar, and USD. Traders with a more bearish view for the coming week are buying put warrants and inverse ETFs or short selling using CFD. All of the products mentioned in this slide are tradable via your Phillip investment account. Do check with a trading representative for more details. That's all for PhillipCapital Market Watch. Do remember to like and follow us on social media and to subscribe to us on YouTube. Also, tell us what you think. Will Trump impose more tariff on China this Sunday, and will there be another shock to the stock market this month? Leave your comments. Thanks for joining, and we'll see you soon.